I think the evidence is actually coming around to my view. And all those people saying if we don't have a recession by now, we're not having one, I think I'll be shown to be right about that by the end of this year. And I think it's starting now. As you and I sit here, I think it's starting. The data is showing it's starting. And this CPI print may fit that. But let's say I'm wrong. Lobo, you're just a tinfoil hat wearing gold bug and, it's always gold to the moon for you, right? Okay, let's say I'm wrong. Well, the mainstream is saying 1 or 2 cuts this year. The Fed is saying 1 or 2 cuts this year. And the market reaction we've got today, back over 2,400 in gold, is saying that's bullish for gold anyway. So, I don't want to say that it's impossible for gold to go down. But if I'm right, if I'm wrong, it goes up. And if I'm right, it goes way up.
The bullish 2024 gold forecast is based on expectations that the U.S. economy will slide into recession, which should fuel speculation about interest rate cuts. The CME Fedwatch Tool indicates a 93% probability of a Fed rate cut in September, which could boost gold's appeal. Non-yielding bullion typically benefits from lower interest rate environments. Lobo Tiggre, editor of the Independent Speculator, is a well-regarded voice in the precious metal sector. Considering current market movements, Lobo Tiggre predicts that the anticipation of lower rates will continue driving gold prices higher as gold thrives in a low interest rate environment. He predicts that those doubting a recession will be proven wrong by year-end while emphasizing that gold will go way up, whether he's right or wrong. Gold prices nudged higher on Tuesday as comments from Federal Reserve Chair Jerome Powell bolstered the case for a September rate cut, while investors awaited more U.S. economic data for further monetary policy cues. According to Tiggre, gold's recent performance underscores its role as a hedge against inflation, even amid current deflation concerns. Despite talk of deflation, he mentions that the core inflation rate remains high, which is bullish for gold bulls. The price of gold has increased by about 29% since June 2021 as inflation started heating up from around $1,800 to $2,320 an ounce. In that same period, CPI increased by 12.30%, according to official Bureau of Labor Statistics data. So, the price of gold has increased by more than twice the inflation rate in this cycle. Even if you double price inflation to keep it more in line with the more honest CPI formula used in the 1970s, gold still kept up with price inflation. In his assessment, Tiggre expresses that he still anticipates a hard landing for the economy, aligning with Danielle DiMartino Booth's views. Now, we present the clips of Lobo Tiggre's insights from his recent interview with Kitco News. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
It's interesting that we're having this particular conversation right now because one of the questions that was coming up was it priced in? Like these rate cuts are so telegraphed that, maybe that we're already flirting with 2,400 shows that it's already priced in. Well, today's price action shows you that no, it's not priced in. And this is actually a takeaway for the audience. You'll see a lot of things that are, like clearly written on the wall, and it's coming, it's signaled by the Fed or whoever it is. But the actual reality, there's always a chance it won't happen. And so there's an arbitrage. And that arbitrage closes when the reality happens. So sometimes even a print that's as expected causes a market movement. Now in this case, it was better than expected if you're fighting inflation. And so we saw a pretty dramatic response immediately. And to be expected, right? The moment that print dropped, I was thinking, Mr. Market's gonna like this. So I took a screenshot and I was posting my thing. And then as I'm typing it, I see, Market Watch, the futures goes like this. So I was able to do both at once. Yeah. But wait a minute, Lobo, if you're a gold bug, isn't deflation bad for gold? Gold's an inflation hedge, right? I knew you were gonna ask me that.
What happened to the inversion?
Yeah, right. We are, you could say, in an inverted economy, a through the looking glass economy, a Fed distorted economy. And so, longer term, yes, gold is an inflation hedge. I mean, just look at a 50-year chart of gold versus the dollar since 1971 when they were freed to change. And it's a giant X shape. Like, there's really no question longer term. The devaluation of all these funny little pieces of paper we call money versus real money, there's no debate there. The problem is that people want gold to do what they think it should do today, right now, right? So gold tends to lead inflation. I think what we're seeing is a lot of people around the world, not just the Chinese, hedging against that inflation that's coming with gold. Because, okay, you say, oh, we've got deflation and the Fed's going to cut. Well, why is it going to cut? Well, because it's responding to its other mandate. It's trying to prop up a weakening economy. And sorry for the long-winded answer, but this is the point, is bad news is good news. The Fed has trained, and the central banks of the world have trained investors that bad news is good news. And so what we're seeing from the mainstream perspective is another bit of bad news. Like, deflation is supposed to be bad. Yes, the voters are upset about inflation, but we don't want them to lose their jobs. Right. So we're in that rock and the hard place coming together here. And people make a big fuss about this, but the reality is that the so-called core number that they're saying that they're guiding their decisions on hasn't budged. We're still over 3% on the core, 3.3, I think, on the core, which supposedly they make their decisions on. So people can talk, oh yeah, we're close enough. But if the Fed's cutting and inflation is still, their chosen metric is still above 3 plus, they're moving the goalpost. I think that's really significant, and I think that's really bullish for gold bulls. Gold bull likes gold. That's not much of a headline for you, I know, but this is an unusual circumstance. I'm still in team hard landing, sort of leaning towards what you're saying with Danielle DiMartino Booth. I don't think we just get the 25 basis points in September and then maybe another one in December that they're talking about. I think we're seeing real unfraying of the labor market, which has long been that pillar holding the consumer up, right, in the U.S., that is the support for U.S. exceptionalism. And it's not just the last, and since we spoke, we've had one or two labor prints. It's not just the last one that shows weakening in the labor market, but the one before. And the JOLTS numbers and never mind the household survey instead of the one that they quote all the time. Like, there is clear evidence of weakening in that one support for American exceptionalism in the economy. So I think the evidence is actually coming around to my view. And all those people saying if we don't have a recession by now, we're not having one, I think I'll be shown to be right about that by the end of this year. And I think it's starting now. As you and I sit here, I think it's starting. The data is showing it's starting. And this CPI print may fit that. But let's say I'm wrong. Lobo, you're just a tinfoil hat wearing gold bug and, it's always gold to the moon for you, right? Okay, let's say I'm wrong. Well, the mainstream is saying 1 or 2 cuts this year. The Fed is saying 1 or 2 cuts this year. And the market reaction we've got today, back over 2,400 in gold, is saying that's bullish for gold anyway. Mm-hmm. So, I don't want to say that it's impossible for gold to go down. But if I'm right, if I'm wrong, it goes up. And if I'm right, it goes way up.
Lobo Tiggre finds it ironic that while Team Biden can claim deflation in June, mainstream economics views it negatively, especially given the Fed's concerns about economic decline. Despite Powell's attempts to sound tough, the market still expects rate cuts, which is evident in today's positive reaction to cooler-than-expected inflation data. The U.S. is back on a disinflationary path, Federal Reserve Chair Jerome Powell said on Tuesday, the 2nd of July. Still, policymakers need more data before cutting interest rates to verify that recent weaker inflation readings accurately represent the economy. Regarding his investment strategy, Tiggre clarifies that he currently favors gold, silver, and uranium due to their recession-resistant qualities. He expresses a readiness to reconsider other minerals once the recession's impact is clearer. Let's get back to the interview.
It's kind of funny. It's one of these be careful what you wish for scenarios where, in some ways, this is great. Team Biden can say, look, we had deflation in June, right? But by the standards of mainstream economics, deflation is bad, right? The Fed's whole thing is we don't want no terrible deflation. That would be horrible. It means the economy is going down. Well, so by their metrics, this is, in a way, a red flag going up saying, hey, trouble, 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 warning. And so maybe it's not surprising that, we are recording on CPI day, but the last couple of days have been Powell day on Capitol Hill. Yeah. And, you've never seen a dove trying to sound so hawkish. Like what he's saying, and we're still talking rate cuts, we see some progress, all this stuff. It's pointing towards the rate cuts. It's dovish, but he's still trying to sound tough, right? It's just, but at the end of the day, you can see the market reaction. Like they're not buying it. And then, so today happens, we don't just have a cooling of inflation, comes in cooler than expected. Mm-hmm. It's the sort of thing the market likes. And of course, Dow 40,000, right? Even Dow, not just NASDAQ. Yeah. Here I am rating on the parade again. I don't want to buy anything because it's a critical minerals thing. But as an optional tailwind, I see that as great. So, do I want to, pile into XYZ critical mineral because California's banning, internal combustion engines in 6 years? Well, no, they're already backpedaling on that, like most countries around the world, and the producers, the car makers, was it Mercedes and some of these others that said, oh yeah, we're going all electric by 2030. They're like, well, maybe 2035, 2040. right? These unrealistic goals are being backpedaled. So if your whole thesis is, oh, I'm buying nickel because we need it for NCM batteries, goes into reverse, you've got a problem.
Right.
If you're buying nickel or copper because they're central industrial metals, the world is going forward, the population is growing, and we're going to need them regardless, and they have an electric car tailwind, that's fine. The electric car tailwind helps you out, and if it goes away, you're still okay. And by the way, I'm not recommending nickel and copper, I'm just giving them as an example. To make something close to a recommendation, I'm not ready to buy any industrial minerals until I'm sure the recession has done its worst. We've talked about this before. Right now for me, it's gold, silver, and uranium, because uranium is recession resistant at the very least. Everything else I'm waiting to be sure that the recession has done its worst, or that I've been proven wrong about that, which will be this year one way or the other. So when that time comes, sorry, it's not nickel, because the Asians have figured out how to supply nickel from non-class 1 nickel sources, and they're flooding the market, and we need to see whether or not that rebalances. Lithium is a maybe. High prices cure high prices. Lithium's not rare. Even with the low prices, there are still new projects coming online. So lithium's a maybe, not a no, it's a maybe. We'll see how the market balance is, because we're still building the EVs and stuff. So there still is a lithium story. But the no-brainers for me are oil and copper. I'm not going to wait to see how the market shakes out or whatever. As soon as I'm confident that the recession has done its worst, or that I've just missed it, there was no recession, this time was different.
Right. Which we'll call you out for.
Right. Either way, oil and copper stocks, that will still be on sale at that point. The carnage will still be, people reeling. That's what I'm looking for as a buying opportunity.
Interesting.
Meanwhile, gold prices have been strong recently, with gold per ounce hitting a record of over $2,400 in May. Although gold prices have come down slightly since then, they're still up over 20% in the past year. Meanwhile, inflation has shown signs of moderating recently, although it could still be a while until it reaches the Fed's 2% target. As we navigate economic uncertainties and potential Fed actions, how do you see gold's role evolving in your investment strategy? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.